Elon Musk plans to take SpaceX public at a valuation of $1.75 trillion, which would make it the most valuable IPO in history. If you think that sounds nuts, most people would agree, but the Nasdaq just changed its rules specifically for SpaceX's IPO that will force nearly half of all investors to buy the stock whether they want it or not. According to the information, SpaceX generated around $18.5 billion in total revenue and posted a loss of more than $5 billion in 2025. That $1.75 trillion valuation carries an implied sales to valuation multiple of more than 100 times. To put that in perspective, NVIDIA's sales to price multiple hovers in the mid-20s. You may already know all of that, but did you know that SpaceX shares may be crammed into your 401k, IRA, or index fund within 15 days of its IPO? That's right. Nasdaq changed the rules for SpaceX, and now you may be forced to own it even if you don't want to. According to multiple insiders, when Elon decided he wanted to take SpaceX public, he started shopping it to the New York Stock Exchange and the Nasdaq. If you're wondering why someone would shop their IPO to different exchanges, me too, so I did some digging. Each exchange has its own reputation, trading standards, and yes, rules. Most of those rules are similar, variations on a theme, if you will. Allegedly, Elon wanted to see who would offer him a better deal, and if that's true, boy did the Nasdaq deliver. Typically, a new publicly traded company lists on an exchange and after several months to a year, gets listed in indexes within that exchange. Nasdaq has one index everybody wants to be included in, the Nasdaq 100. That index tracks the largest non-financial companies in the exchange. The reason everybody wants their stock listed in the Nasdaq 100 is because there are massive ETFs and index mutual funds that trade exclusively Nasdaq 100 stocks. You know that Invesco commercial you see all the time promoting their QQQ fund? That's a Nasdaq 100 fund. That means if you own an ETF, mutual fund, or have IRAs or 401ks, you likely own some funds that contain stocks listed in the Nasdaq 100. Now, why does that mean you'll be forced to own SpaceX? Well, as part of Musk's negotiation with Nasdaq, he got them to change their rules about how fast SpaceX would be included in the Nasdaq 100. Instead of nearly a year, the Nasdaq is allowing SpaceX to be listed in the Nasdaq 100 in 15 days. And once it's listed in that index, all those mutual funds and ETFs start buying it at any price almost automatically. So congratulations, you're about to own SpaceX, even if it's the most ridiculously overpriced IPO ever. I guess if you really didn't want to own it, you could switch your allocation to an S&P 500 index or something unrelated to the Nasdaq, but since most people won't realize this is even happening, they won't change anything. Now, most investors' portfolios have less than 1% allocated to a Nasdaq 100 fund, so you're not going to see your portfolio change much. But it's estimated that this fast tracking to the Nasdaq 100 will create between $35 and $50 billion worth of forced buying by index funds and ETFs. None of this is an accident. Musk knows that in order to list at a ludicrous valuation and keep the share price high, he needs to restrict supply. More about that in a minute. And if he can get patient money, meaning buyers that plan to hold positions for months, if not years, there's no better place to be in an index that algorithmically buys every stock in the Nasdaq 100. And the Nasdaq didn't stop there. They also waived the 10% float rules for SpaceX. The public float just means any stock needs at least 10% of its shares freely trading to get into the Nasdaq 100. That minimum has now been scrapped for mega IPOs like SpaceX. You know, one of the best ways to support small YouTube channels like mine is to subscribe. If you like the content and you'd like to see more of it, consider subscribing. Back to the episode. So not only does this allow SpaceX to withhold 90% of its shares from public trading, it also means they are overweighted in the Nasdaq 100. That combination creates that forced buying scenario I just mentioned. QQQ and other Nasdaq 100 trackers must buy a large dollar amount of SpaceX shares in a very short window, chasing a much smaller pool of actual float, which can help keep the IPO valuation inflated. Maybe that doesn't seem too bad to you. Nasdaq is allowing SpaceX to manipulate the supply to buoy an insanely high IPO valuation. And if I'm on the right side of that trade, good for me, right? Maybe. there are a few things we need to consider. First, most IPOs end up broken. According to Schwab, 2021 to 2024 IPO cohorts show that a majority of high-growth tech IPOs ended up below their IPO prices within 6 to 18 months. Not all IPOs that break stay broken, many roar back to life, but there are several big tech IPOs that haven't rebounded. Rivian lost about $54 billion in market cap from its IPO peak, with the stock being down over 80% from early highs at one point. Coinbase was down 84% from its first day closing price at one point, and Bright Health lost 99% of its value in less than 2 years after its IPO. It's interesting to note none of those were included in the Nasdaq 100, limiting broad market exposure. Most IPOs break within a few months, with some rebounding and others continuing to sink. But this IPO, at this valuation, with this amount of beneficial rulemaking, has literally never been seen before. And what if Musk and his cronies at the Nasdaq pull this off? Let's say he gets even close to the $1.75 trillion IPO. Has a precedent now been set for the mega IPOs likely coming behind SpaceX? OpenAI and Anthropic are about to be handed the playbook. They'll know what to ask for from Nasdaq management, how to play the investment banks off each other, how much float they should restrict, and watch the mutual fund managers jam another bloated, overpriced stock in our retirement plans. To be clear, this isn't a criticism of Musk or SpaceX per se. Nasdaq changed their own rules to accommodate SpaceX. Musk just asked them to do it. They didn't have to agree, but they wanted the listing to be able to crow about that to future IPO wannabes. They get the trading fees, and it costs them almost nothing to change their own rules. But I'm not interested in owning this turd of a stock, and I shouldn't have to. I shouldn't have to divest whole mutual funds or ETFs just to avoid this exposure. I don't want to participate in this shared hallucination that a company generating less than $20 billion in revenue and delivering $5 billion in net losses in 2025 is somehow worth nearly $2 trillion. Given the mechanical linkage between the Nasdaq 100 index and the forced buying it creates, where are the regulators on this one? We've now reached the point where an exchange, supposedly an unbiased marketplace for buyers and sellers, is foregoing its own rules that offer some protection for investors from companies that have not demonstrated their fidelity as a publicly traded company. Noah Widener at The Street may have summarized it best when he wrote, quote, "Evidently, Nasdaq sold out passive investors by guaranteeing inclusion to SpaceX, clearing the way for more tech giants to do the same. Investors in the Nasdaq funds will end up becoming forced buyers of these assets at the highest valuations that the public markets have ever seen. It'll be like a lottery ticket." And if you've made it this far in the episode and are still wondering why I'm harping on this one thing, I hear you. But it isn't just this one decision by the Nasdaq. That's just the latest example of how the financial, regulatory, and legislative systems pretzel themselves into knots to cater to the rich and to powerful businesses. In the last year, there have been multiple rule changes and proposed rule changes that further benefit corporations over their shareholders. From Delaware changing investor rights provisions in their corporate registrations to appease Mark Zuckerberg, to the SEC proposing that public companies only have to issue reporting twice a year as opposed to each quarter, to the IRS tax code growing from 400 pages to 7,000, with more than 50% of those provisions specifically benefiting the top 10% wealthiest taxpayers, we are the frog slowly being boiled on the stove. We don't lose free markets, market transparency, and equal opportunities in one swift move. We lose it slowly, over time, and without anyone noticing. And why? Because we collectively have the attention span of a goldfish and we let them get away with it. Regulators didn't miss this SpaceX sweetheart deal, they enabled it. The same way they've been quietly tilting the rules toward the wealthy and big corporations for years. They tear up listing standards for a $1 trillion IPO, relax reporting for public companies, and layer a tax code so dense that more than half of the real benefits flow to the top. And unless people start paying attention and pushing back, this SpaceX move is just a preview of what's coming next. That's it for this episode. As always, like, comment, and subscribe, and we'll see you next time.